let's talk about the advantages of the Forex. Because it is the largest and most liquid market in the world, here are some of the benefits as well included. There is 24-hour trading. All right, so this is a great, great advantage because you can literally trade whenever you'd like. If you want to trade before work, after work, even during work, you can do it. There are no, oops, excuse me here, I kind of jumped the gun. There are no limit up or down moves. So if you're a futures trader, you know how difficult it is sometimes getting locked into a bad, situation when the commodity or future stops trading. You're locked in. It had to limit up, and so it can no longer trade anymore until they settle everything. Well, you don't have to worry about that because of the 24-hour trading here with the Forex. It's always liquid. You can begin trading with very little capital. Many brokerage firms will allow you to trade $200, $300 to start up, open up a mini account. There are technical and fundamental advantages to this. If you're a technician such as myself, the Forex markets lend themselves greatly to looking at charts and indicators. But if you're on the other side of the fence, if you're a fundamentalist where you like to look at news and reports and things going on around the world, well, it's perfect for that as well, because there's always information coming out from different countries where these currencies are derived from. And finally, these are tremendous trending markets. In my opinion, they're the best trending markets out of all the markets combined. Because of this tremendous amount of capital flowing in and out on a daily basis, they lend themselves to trending markets. So this is what we're looking for. All right, let's talk about now the two basic concepts for constructing your own trading strategy. Now remember, regardless if you're a technician or a fundamentalist, you like to day trade or you like to hold on to positions, it doesn't matter. You should be using these concepts, whatever style, whatever market you're involved in. All right, here are the two concepts now. Always trade with the trend. The trend is your friend. I'm sure you've heard it a million one times, but let's be honest. Think about when you've had a series of losing trades, or think about if you've known someone who's had a really bad time trading any market, stocks, futures, commodities, Forex. Were they in sync with the trend? If you go back and look at their list of losing trades, most of the time they were out of sync with the trend. They were trying to pick a top or trying to pick a bottom. Now, not to say that you can't make money that way, but it's very, very difficult. I've been trading for 30 years, and it's even difficult for me. So I would say the majority of my trades are always looking to trade with a trend. It's much easier to sleep at night when you know you're in sync with the trend as opposed to trying to fight it, trying to swim upstream. So I would say, starting off the bat, you always want to trade with the trend. All right? Now, once you've found the trend, then look to trade the pullbacks within that trend. Now, what exactly does that mean? Well, we want to look at these smaller time frame little blips and dips within the trend. In other words, if you have a currency that's been going up, if you go to a smaller time frame, such as a 5 or 10 minute chart, you'll be able to see these small little sell-offs or small little dips within price. And then they go back up. These little dips are called pullbacks. They're pulling back to some level, and this is where we want to get in. It's a much more higher probability trade because we're buying at lower levels, and then once the trend resumes upward, then we're exiting into strength. So it's a great, great concept, two great concepts, a great philosophy to trade this way. All right, so let's take concept number one, trade with the trend. Very difficult sometimes to find a trend. One person's uptrend can be another person's downtrend. So how do we find the trend? Well, one of the best ways I know is using the indicator we talked about earlier, the FX RPM. Remember, anything with a 1 or 2 should be in an uptrend. Anything in a 17 or 18 is going to be in a downtrend. So right off the bat, you've already solved concept number one if you simply look at the indicator. Here's the way it works. Here's an example here in the dollar Japanese yen, where the up green arrow is where a 1 mode flashed, right on this bar right here. And then you can see we had a very nice uptrend ensue after that. Okay, this is not a trading system. This is just a bias telling you what direction the trend is probably going to be going. Now on the downside, we have a snapshot here of the dollar Canadian dollar, where the 18 signal flashed. Look what happened after that. We went into a very strong downtrend. So remember, this is a great tool to find the trend. This is not a trading system. We're not telling everyone if you see a 1, go out and buy it, or you see an 18, go out and sell it or short it. It's just telling you where the trend is. All right, so we found the trend. Now what do we want to do? We want to go to concept number 2, which is trading the pullbacks in the trend. So we want to go to a smaller time frame and look for the pullbacks. Now, best way I know how to describe this is we're going to go to a 5-minute time frame of those same charts, and we're going to apply a 20-period simple moving average. Now, we're only going to do this to show you the range of where these pullbacks take place. Here's that same chart we looked at earlier in the dollar Japanese yen. Excuse me here, we seem to be having a little, we had a 1 flash up there. We'll make sure that that leaves in just a second. There we go. That was an old date we had up there we took off. Here's the dollar Japanese yen. Okay, same chart we looked at earlier. Here's where we had the number 1 signal flash. But now we're on a 5-minute time frame, and as you can see, earlier on the daily chart, we would have said, well, where exactly do we find the pullbacks? When you go to a smaller time frame, you can see the pullbacks very easily as they pull back to a 20-period simple moving average. They pull back, they rally again, uptrend, then they pull back again, go back on an uptrend, pull back, and so on. Time and time again. So when you go to a smaller time frame, you can see these small little dips taking place. They're called pullbacks. So usually they pull back anywhere to around the 20-period simple moving average. On our next slide, this is the dollar Canadian dollar we looked at earlier. Here's where the 18 signal flashed. And now once again, we're in a 5-minute time frame. And look at the pullback every time we pull back to the 20-period simple moving average. Then we resume our downward trend. We pull back again. Then we resume downward, and so on. So once again, this is not a trading system. We're not telling you, well, all you have to do is go to a 5-minute time frame, and every time it touches the 20-period simple moving average, you either buy or sell. That's not what we're saying. This is just for example purposes, for displaying the ranging, how a pullback looks and how it takes place. All right, so let's look at a recent chart. These last 2 charts I showed you were roughly about a year or so old, just for display purposes. So let's see how this happens in real time. This is about 3 weeks ago in the dollar Japanese yen. Here we are on the 7th of November of this last month. Now, as you can see, we're in a clear-cut downtrend. But remember, we want to trade these pullbacks. But we can see these little bounces here every once in a while. So those are clear-cut bounces. But where exactly would we know when the pullback has ended? Well, one example, once again, is we just simply add a 20-period simple moving average. Now, as you can see now, it's the same exact chart, but every time price pulled back to the 20-period simple moving average, we were at the range of some pullback entry system. It still was not telling us exactly where to get in, but you could construct some type of system, entry system, to go short every time we got back in these ranges where we have circled in red, because this is where the pullback range was high probability to get back in and to go short. So this is a concept we're trying to get, really started with, these 2 concepts. Look for the trend. Only trade the trend, because in this example, in the dollar or Japanese yen, had you tried to go against the trend and buy it and say, well, you know what, this has come down further enough, I think I'm going to buy it now. Look what would have happened. You would have got caught up in this blip when you actually should have been shorting, and then price went much lower. So that's what happens when you're trying to pick tops and bottoms. It's not that it can't be done, it's just that it's very extremely difficult. So why not go in sync with it? It's a lot easier, you'll sleep a lot better at night, and you'll be in sync with the currency. You'll be in sync, or you'll be doing what the currency is doing. In other words, if the currency is going down, well, then you're betting for it to go down. That's all. And then once you've figured out the trend, then look for the pullbacks. Go to a smaller time frame, such as this. This is a 5-minute time frame. And you could have taken 3 or 4 trades here today with relative ease, or on this particular day. Now remember, this is not a trading system. There are no exact entry and exit rules. If you're interested in some type of pullback strategy, I invite you to join me this coming Monday for advanced class. If it's a little bit too advanced, if these concepts are a little bit too advanced for you, I invite you to continue to join me on our beginners classes, and we'll continue to go over this concept until you really understand it. But if you do understand this concept, join us on Monday, same time, for our advanced class, and I will give you the actual rules to an entry and exit system, where you will be trading on the same philosophy, entering and exiting on pullbacks. All right, we are at our question and answer portion now, as promised. If you have any questions regarding what we just went over today, feel free to ask them. I hope that everyone got to see everything okay. Once again, I'm never sure if you're seeing this fine, but I hope it was okay. Remember, this is a beginner's class, so if I stick to a beginner's mode rather than going over any type of advanced class, come back to our Monday class, I should say, and then I will be more in tune to answering questions that are more advanced. Okay, I see some people typing, so great. I assume that everything went okay with the presentation. Okay, my first question is, can we use 20-period simple moving average on higher time frame? Yes, you can. I have found that it works probably better on a shorter time frame, such as a 5, 10, 20-minute, even 30-minute. But yes, I've seen it work well on daily bars, even weekly bars. And remember, it's just meant as a guideline to show you where the pullback may be ending. It doesn't mean that it's going to end exactly when it touches that 20-period moving average. So, by all, please do not use it as a trading system. It's just meant as an example to show you, well, we're at a range now where we are probably most likely in some type of a pullback mode. But yes, go ahead and experiment with it. Second question, is your email correct as 2 have been returned and not deliverable? Oh, wow, I apologize. We may be having problems. I will see my tech guy about that. I know we just switched over our servers for the email, and that may have been the problem, so I will check that out. I apologize for that. We switched servers over, and that may have been the problem. Also last week. Okay, sure. I'll check it out. Thanks for letting me know, because I didn't know. I hadn't received anything, so I thought I was just teaching great classes and everyone understood everything. But remember, for all those who do have questions, here's my email address. But I would say wait out for a while on that, as I was just informed that we may have problems. But my usual address is steve@thefxmarkets.com. But if you'd like to speak to someone live at this moment right now, you can call these 2 numbers, 888-484-8220, extension 1. That's in the U.S. Or if you're outside the U.S., you can simply dial 213-955-5858, extension 1. So either way, you can reach someone. If the email is down as it is right now, what will probably best is you can speak to someone live, and they'll answer any questions or go over this presentation. Explain the FX RPM tool to you as well. Okay, any other questions while we still have us here? I see someone is typing in. Can we have your home number too? No, I'm sorry about that. I'm here all the time anyway, so it really doesn't matter. One of the things I want to stress out, once again, about trading the Forex. Now, as you've known, those of you who have joined me before, I come from a totally and completely, I'd say 99.9% technical background. It's just my nature. And I want to explain that you can either be a technician or a fundamentalist or kind of both in between. There is no right or wrong way. The only wrong way, in my opinion, is when you're out of sync with who you are. Because I believe that you're either born a technician or born a fundamentalist. You can't, switch teams. If you rely totally on technical information and then all of a sudden you say, well, you know what, from now on I'm only going to look at news. It doesn't work that way. I think it's in your nature. And there's nothing wrong with it. Just different ways in which to view the markets. And both roads lead to the same place. If you're doing them right and doing them correctly, you should have profits. So the point being is that I come from a technical background. And remember, that's just what works for me. I don't want to persuade or say that the only way to make money is by looking at charts and looking at indicators and trading, with moving average lines and graphs. If you are totally a fundamentalist, if you only like to look at, projected reports or things that are going on in the country, worldly news, and that works for you, well, then that's fine. I would suggest you should stick with that, because I've been trading long enough to know that the real demon is being out of sync with your own personal style. It's not that you have a bad strategy. It's not that you have a bad system. It's not that you're doing something wrong. Most of the time, it's just that you're out of your niche. So if you found that your niche, you gravitate towards charts, well, then you should be a technician. If you gravitate towards looking at TV and watching the news and getting fundamental reports, then you should be a fundamentalist. That's all that really matters. All right, so we're just about to the end of today's class. If you have any more questions, let's see, are 3 to 16 in order of ranking also? It's a good question. The question is talking about the FX RPM. And remember, they're in order of ranking, but basically, they're in a neutral zone, anything from 3 to 16. And that basically means is that there isn't a real big discernible edge there. The algorithm is really looking for an edge. And even though 3 is closer to 2 and 1, it's still not good enough to be have a strong upward bias. So remember, we're just saying that it doesn't mean, let's say you like a currency, say the dollar yen, but it's ranked a 4 or 5. It doesn't mean that it won't go up. It's just that our algorithm could not pick up an edge with that. That's all, or whatever it's based on. Question is, how do we get the free FX RPM? All right, just simply go to our website. Our website is thefxmarkets.com, and you'll see it displayed there right on the home page. Now, I believe you have to sign up for it, but there's no sales involved, nothing, and there's no cost. All you have to do is just register, really. And once you do, you can register for live time. And what I suggest to most people and all my students is, paper trade with it for a while. The minute you see something that works, don't put all your money involved in it. In fact, just look at it for a couple of weeks or a month and see if it works for you. It works well for me in the style that I trade. Someone may be trading a totally different way and it may not work. But it's a free, it's a free, valuable tool. So use it on paper for a while to see if it fits in with your style. All right. Well, if there are no more questions, once again, our toll-free number is 888. You can see it on the screen there. 484-8220 extension 1, or outside the U.S., 213-955-5858 extension 1. Okay? And remember, I will be trying to work on my email as soon as possible, so I apologize for all the people who are trying to reach me that way. Thank you so much for joining us. Hope to see you at our advanced class where I'll be giving strategy number 2, and that will be on Monday at the same time. Thank you. See you next time. Bye-bye.